Welcome, everybody. Excited to bring you our Q2 market commentary and a EWA portfolio update. This is happening in the middle of Q2 due to some economic conditions that have changed and some trades and rebalancing that we have recently completed. So if you remember, in late February, the major focus of our Q1 trade was to reduce the magnitude of our risk-on stance and seek ways to build greater resilience into our portfolios. We maintained a high degree of long-term optimism but anticipated increased near-term volatility. Since then, it is certainly fair to say that equity markets, in particular U.S. equity markets, experienced historic volatility, with investors witnessing a sharp drawdown largely attributed to trade policy uncertainty, followed by a swift recovery over recent weeks. The decision to hold steady during such a turbulent period was bolstered to our proactive risk reduction in February and post-election trades into scarce assets like gold, which helped soften the impact of those recent market swings. Focusing on what we were doing in this trade, we are tactfully reducing risk, both total and active risk, while maintaining a moderate risk-on tilt. Specifically, we are cutting our equity overweight from 3% to 1% and trimming our U.S. overweight, moving closer to neutral in our regional positioning. The recent recovery in U.S. equity markets gives us an opportunity to recalibrate our risk-on stance, given the shadows of trade policy and geopolitical uncertainty still looming large. Within U.S. equities, we are rotating away from broad market exposure into more granular, high-conviction positions. We are emphasizing mega-cap and artificial intelligence companies with resilient balance sheets. Potentially long-term structural growth drivers, while also increasing exposure to actively managed strategies that can more tactfully exploit dispersion and volatility in today's market environment. Outside the U.S., we are adding the value-oriented international developed market stocks and moving to neutral on emerging markets, as well as neutral to China by allocating to broad emerging market exposure. The short-term aim of the emerging market trade specifically is to mitigate exposure to highly sensitive policy headline, the volatility, despite retaining long-term caution on China specifically. Within fixed income, we are introducing exposure to short-term inflation protection, adding global diversification through non-U.S. core bonds, and marginally increasing duration. The combination of these moves is intended to improve diversification characteristics of the portfolio overall, while hedging potential near-term tariff-driven inflation surprises, while building in resilience against possible slower growth and more pronounced disinflation later in the year. Since we traded in February, there's been no shortage of news or volatility surrounding the markets. Specifically, on March 4th, tariffs on Canada and Mexico, specifically their imports, took effect alongside increased duties on select Chinese goods. Retaliatory measures from all three countries followed swiftly, and within just a matter of days, we saw exemptions, implementation delays, and countermeasures, setting the stage for both how much uncertainty as well as the speed of changes we've experienced around the policy in the last several years. On April 2nd, the much-anticipated Liberation Day sent shockwaves through the market when the Trump administration announced a baseline 10% tariff on nearly all U.S. imports, excluding Canada and Mexico, along with the reciprocal tariffs for another 57 countries labeled chronic trade offenders, including the EU, China, and Vietnam. Global equities reacted sharply, with the S&P falling 14% in the subsequent just 3 days following, including the fifth worst two-day decline since World War II. The NASDAQ entered bear market territory from the February highs, while Treasury yields fell at the fastest pace since COVID. As quickly as markets panicked, they just as quickly found relief when on April 9th, President Trump paused most country-specific tariffs for 90 days, excluding China, leading the S&P 500 to gain 9.5% in a single day. In the bond market, the 10-year U.S. Treasury rose 50 basis points for its biggest weekly gain since 2001. In addition to the uncertainty around trade policy, other areas of focus have included geopolitical escalations, change in inflation, interest rate, and even Fed member expectations, a U.S. credit rating downgrade, amongst many others. And yet, April ended the month largely when we began. It was a historical month, not only for the events highlighted, but never before had the S&P 500 fallen more than 12% intra-month, only to close down less than 1%. The dramatic reversal underscores the incredible unique environment we're in, with an administration that is driving this high degree of uncertainty. In this environment, we're seeing the importance of portfolio diversification amid extreme market swings, and having a more deliberate diversification strategy that goes beyond traditional stocks and bonds has been valuable. We added to gold during our last rebalance in anticipation of an uptick in geopolitical volatility. Since then, prices have surged, climbing 11% from February 28th to May 15th. Gold has served as a portfolio stabilizer this year as investors sought safety amid a choppy market environment. As we've highlighted, going back to the last fall, global central banks continue to significantly influence demand for gold, holding nearly 20% of all physical gold ever mined and continuing to increase reserves in response to increasing geopolitical tensions. Importantly, gold's duration-like qualities have not been exhibited this year, as week-to-week changes in gold prices have been largely uncorrelated with Treasury returns, adding further to our portfolios. We are capitalizing on gold's strong rally by tactfully trimming our positions to realize gains. We maintain conviction in the asset's long-term role as a diversifier, especially given increased U.S. dollar volatility, and see this as an opportunity to take profit while preserving upside potential. Other diversifiers and stabilizers that have supported performance, including our positions in international equities, in particular, developed market value stocks and U.S. Treasuries. Developed market, excluding U.S. equities, have delivered strong year-to-date returns on the back of rising regional defense spending and challenges to the U.S. growth narrative. Within fixed income, U.S. Treasuries have also delivered on their traditional role as a portfolio stabilizer amid a flight to quality. Markets have rebounded remarkably fast from the lows on April 8th. Looking at the Fear and Greed Index, investor sentiment bottomed at nearly zero in extreme fear in late March and shot to greed by May, just 2 months later, as equity markets rallied. Recession fears have also largely abated in the same period, as polling suggests market participants now think the odds of recession are much lower compared to 1 month prior. Despite this shift in market narrative, we are more cautious given that many underlying drivers of near-term volatility still exist, and we've yet to see the full impact of tariffs in the data. With policy uncertainty and geopolitical fragmentation, we've seen how reactionary markets can be to headline volatility, and we should anticipate more spurs of de-escalation and re-escalation. Our outlook, therefore, is one of cautious optimism. Although recent tariff actions could lead to modest short-term inflationary pressures, we believe these effects are likely to be temporary and insufficient to disrupt the broader structural disinflation trend. What remains quite unclear is the potential impact of global growth, as supply chain disruptions and shifting business sentiment could weigh on economic momentum, along with continued volatility while policy is negotiated. Given this backdrop, we still expect the Fed to look past near-term pricing noise and focus more intently on signs of softening and growth in labor markets, likely delivering a few additional rate cuts later this year as markets are anticipating. However, in the face of expected volatility over the next few months, we are scaling back active risk and staying closer to home, especially within our asset allocation and regional exposure. In this environment, we believe the most effective approach is to stay anchored to our highest conviction ideas while maintaining broad diversification in order to balance upside potential with portfolio resilience. Without question, the biggest driver of volatility today has centered on the U.S.-China trade negotiations. Trump has emphasized narrowing the U.S.-China trade deficit as a key policy objective for his administration. This stance has led to a series of escalating tariffs on Chinese imports, beginning in February and peaking at 145% tariff rate on Chinese goods by April. In response, China imposed retaliatory tariffs on U.S. exports, reaching a high of 125% during the same period. A temporary reprieve arrived on May 12th when both sides agreed on a 90-day pause and rolled back tariffs by 115%. Post-agreement, U.S. tariffs on Chinese goods stand at 30%, while China duties on U.S. goods settled at 10%. We see scope for tariffs to come down even further depending on negotiations during this 90-day pause. And there is a shifting tone from the White House. Completely decoupling from China is not likely in the near future, with certain products like medical equipment, semiconductors, very unlikely to see onshoring. For these reasons, we see an opportunity to tactfully reduce our China underweight. As discussed in prior trades, we still remain cautious on China due to ongoing structural concerns, including an opaque regulatory environment, persistent distress in the real estate sector, which we've covered many times in the past, and heightened geopolitical uncertainty. Our shift brings emerging markets exposure closer to neutral and aims to reduce headline-driven volatility amid ongoing U.S.-China negotiations. Especially during this 90-day pause window, we see potential for greater clarity on bilateral relations in the months ahead, an outcome that markets may not have fully priced in yet. While it appears that the initial worst-case scenario surrounding trade talks and tariffs may have been avoided, it's important to note that an effective tariff rate approaching 15% would still be the highest we have experienced in nearly 100 years. Higher tariffs are dampening expectations for future global growth. Confronted with heightened uncertainty and century-high duties, many global businesses have withdrawn or lowered revenue forecast. The IMF now projects global growth of 2.8% this year and 3% next year, down from the previous estimates of 3.3% both for 2025 and 2026. Despite soft data for both consumers and businesses coming in very weak as of late, the hard data does continue to hold fairly strong, and so we'll be monitoring this divergence closely. While recession does not remain our base case, and we anticipate further support for the market from both the Fed and from fiscal policy, we've seen the U.S. equity market rally nearly 20% from the lows, which we feel gives us an opportunity to cut risk in a period of time where key trade talks remain unresolved. Market pricing has returned to what feels more like euphoria than a mid-cycle slowdown. And with so much macro uncertainty, being more defensive in asset allocation, while being selective in security selection, can be a winning formula with so much dispersion in place. While the potential growth impacts from tariff policy are one consideration, the potential for inflationary effects are also something worth noting. Jerome Powell and the Fed have indicated that they view the tariff shocks as a one-time event, and we're inclined to agree. As most tariffs apply to goods, this is also notable for our view on growth, given that the U.S. is a service-oriented economy. Looking at real-time price data from Trueflation on the right, we've already seen a bit of short-time spike in inflation. Trueflation indexes are released daily, making them one of the world's most up-to-date and comprehensive inflation measures. The chart shows the year-over-year percentage change today versus a year ago, and we can see that the uptick in real-time inflation since announcement of the tariffs as consumers and businesses front-loading purchases in March ahead of policy changes. Even though it may take several more months to feel the full impact on tariffs, we'd also point to the disinflationary trend we have seen all year. On the left-hand chart, you can see that April PPI fell from 0.5%, the largest monthly decline since 2009. Similarly, we saw April headline Consumer Price Index print at 2.3% year over year, which was the lowest print since February of 2021. We think the Fed is still very much inclined to continue to cut rates given this long-term trend. Having already lowered rates 3 times last year, for now they have taken a pause, awaiting more data on the effects of tariffs, immigration restrictions, and potential tax cuts. Given our view that the inflation impact will be short-lived, we favor short-term, Treasury inflation-protected securities to hedge against these temporary shocks. Although short-term inflation shock from tariffs is likely, weakening job data points to potential near-term rate cuts. This aligns with the Fed's dual mandate to promote maximum employment and stable prices. Current labor market trends give the Fed reason to consider resuming stimulative cuts to support employment and keep joblessness near target. The latest job reports showing the unemployment rates unchanged at 4.2%, while the number of people settling for part-time work due to lack of full-time opportunities has surged. This pushed the broader U6 unemployment measure to 8%, its highest level since October 2021. The graph on the left from the link up tracks total U.S. job openings from 10,000 global employers. Openings rose in the first quarter, but stalled as tariff-related uncertainty has led businesses to pause hiring. The job market now feels frozen. Companies are reluctant to hire amid market volatility, but also hesitant to lay off workers in case conditions improve. The beverage curve on the right illustrates the inverse relationship between unemployment and job openings. A tight labor market characterized by low unemployment and high openings appears in the upper left of the graph and signals economic strength. A slack market, high unemployment, and low openings sits in the lower right, often signaling recession conditions. As of now, we sit on the cusp between tightness and slack, with inflation shocks expected to be transitory. The Fed may soon pivot back towards easing, making this a critical moment to stay nimble in both duration and risk positioning in the portfolio overall. Amidst elevated macroeconomic uncertainty, we continue to believe that investors will prioritize earnings, resilience to identify investment opportunities. And that is where we continue to lean in through our portfolios. As a result of this trade, we reduce total active risk. We are increasing exposure to several high conviction themes, namely mega cap and artificial intelligence stocks, with a preference for active management where possible. Artificial intelligence equities have been pressured by recent sell-offs, largely due to their dependence on globally integrated chip and hardware supply chains. The U.S. administration is committed to maintaining its AI leadership and is expected to implement export controls and other trade measures to protect that edge. This year, the top 4 U.S. tech spenders, Amazon, Microsoft, Google, and Meta, plan to deploy over $315 billion in capex, primarily to expand AI infrastructure. We expect this investment wave to continue, driven by structural demand for AI computation, even amid trade tensions and macro uncertainty. Analyst estimates for these heavy AI spenders, as well as for the rest of the Mag 7, project robust earnings growth, particularly in 2025 and 2026. While growth rates are expected to moderate compared to the prior 2 years, the Mag 7 companies are still projected to outperform the S&P 500 in earnings growth, as seen in the chart on the left. In this environment, while exposure to the AI theme itself will likely reward investors in our view, we believe bottom up, fundamental, active management by technology specialists may offer an even more effective expression of this view. Experienced AI investors can make targeted bets across the AI stack from hardware and software to data. As the theme evolves, a flexible, research-driven approach will be key to identifying the next wave of beneficiaries. Consistent with the overall themes of this trade, one area where we saw an opportunity to enhance diversification characteristics of our portfolios was the addition of international bonds. The current macroeconomic backdrop, whereby we see global central banks like the ECB shown here, attempting to combat lower growth and acknowledge lower inflation by cutting interest rates more often and more aggressively than the Fed. This creates a near-term opportunity in our view to benefit tactfully from non-U.S. government and investment-grade bond exposure. We spoke about the one-time inflationary shocks that would take place inside the U.S. as a tariff country, but what is interesting at that point is that this will also result in one-time deflationary shocks for tariff countries, which is the rest of the world. This should actually put more downward pressure on rates in regions outside the U.S. and thus create potential upside price appreciation for non-U.S. bonds as these effects are realized. In addition, the specific expression of the non-U.S. bond exposures being added in this trade is hedged to the dollar, providing additional attractive carry into our fixed income sleeve. If one expects, as we do, the ongoing trade-related negotiations will be uncertain in their outcomes and their magnitude, we aim to layer in additional diversification and return potential from non-U.S. bonds, which could benefit from a continued trend of outperformance and, importantly, lower levels of volatility versus core U.S. bonds, as we have seen in recent realized market returns shown on the chart on the right. So to summarize all of this, you will notice a equity overweight. So if we take an 80-20 portfolio as an example, previously back in the February trade, we were 4% overweight, so 84% equities, 16% bonds for a normal traditional 80-20 portfolio. And now our 80-20 portfolio is still overweight, but it's now cut down to 81% equities, 19% bonds. The second thing, you're going to notice two new funds in the portfolio. These are active ETFs, so still very low cost ETFs, but these can hold high conviction trades such as noted mega caps and AI companies specifically. And the last but not least, we enhanced diversification and fixed income amid growth and diversification risk. So if we look at the portfolio overall, we are closer to the benchmark, specifically in our U.S. versus international exposure. We were much heavier on U.S. In the last 2 years, but now recently, looking at a 100-0 portfolio would be 73% U.S., 27% international, which would be broken down mostly in developed markets and also a smaller exposure to emerging markets. As always, please reach out if you have any questions on your portfolio. By the time this video hits your inbox, the trades will have already been made. But if you'd like to schedule to ask any questions to your advisor, please reach out, and we look forward to also reviewing this data and the recent changes during your next financial planning review.